Good afternoon, everyone, and welcome to the 2024 tax update for mergers and acquisitions. This is the fourth of the quarterly perspectives on tax law series for 2024. My name is Mike Coburn. I'm a tax partner in the Vancouver office of Fasken. My practice is a broad corporate and commercial practice with considerable M&A activity. I'm joined today by my partner in Montreal, Quentin Lageix, who I think has a similar practice, except he can do it in two languages. We're going to talk about a number of things today, but before getting into that, there are a few administrative matters to mention. The materials today can be downloaded via the handout tab. If you do have any questions, and we very much hope you do, these presentations are always better with questions for sure. Please put those questions in the Q&A box. There's also a survey, which again, I would encourage you to complete, as we often look at those to figure out ways to improve these things. If you have any technical issues, please click the tech support button at the bottom of the video window page. And finally, if you'd like closed captioning, please click the CC button under the video window. So moving on to a bit of an outline for what we're going to cover today. And this is the M&A review has been something we've done for each of the past 3 years. And we tend to cover sort of developments that we're seeing in the tax space in M&A. And we try to cover a fairly broad sort of ground. So we've got a number of things we're going to talk about today, so I'll get into it. But basically, as an overview, we're going to talk about cross-border acquisitions, and Quentin will walk us through exchangeable shares and other issues related to that. We will talk about maybe what was the biggest change in the tax world in 2024, and that was the change to the inclusion rate on capital gains. Talk about how that might impact M&A. I'll give a brief update on the mandatory reporting rules. Quentin will then walk through some issues with respect to incentive plans, which is always an important consideration in M&A deals. He'll also talk about due diligence and the role of tax in that. I'll provide a very brief update on the general anti-avoidance rule. And finally, Quentin will finish off, as we often do with this, talking about what, if anything, unique to Quebec has come out in the last year. So with that, I will turn it over to you, Quentin, to talk us about cross-border acquisitions.
Thank you very much, Mike. So hello, everyone. Thank you for taking the time to join us today. Mike and I wanted to revisit exchangeable shares transaction and cross-border acquisition because it's something we are seeing more and more, and we've seen quite a lot in 2024. I think Mike discussed this subject 2 years ago, but really since the last 2 years, there was a significant pickup in U.S. and non-U.S. foreign purchasers looking to acquire Canadian targets. And more often than not, exchangeable share transactions become front and center in such context. For the people in the attendance that are not quite familiar with what is an exchangeable share structure and what is an exchangeable share transaction, essentially, it's a setup where a buyer proposes to pay in whole or in part consideration that is equity, and by equity it can be shares of a foreign corporation or units or partnership interests of a foreign partnership. But really the gist of it is equity that is non-Canadian equity, such that our customary rollover provisions cannot apply. So result is Canadian vendors are generally not allowed to claim or to transfer the shares of the target on a tax-deferred basis, which makes the deal much less palatable to them because often it results in them having to prepay taxes. Not only that, but also forego a significant, sometimes, portion of the non-equity consideration received in the course of that potential transaction. So essentially, exchangeable shares, that's the relief. That's how we can accommodate that setup with a tax-deferred transfer. And essentially, we realized that by having the Canadian vendors exchanging the shares of Target for shares of essentially a taxable Canadian corporations, to such that a rollover on a tax-deferred basis is possible. So the relief is really a deferral play. The rate arguably would remain the same if law is not amended between the exchange and the liquidity event. But in a lot of cases, it allows the vendor to transfer on a tax-deferred basis and keep skin in the game in the purchaser's equity for a long time. So, apologies. This is essentially an illustration of how it's implemented. Without an exchangeable share structure, essentially the Canadian shareholders received non-Canadian equity in a foreign entity. So that exchange of shares of a Canadian corporations or a Canadian target for non-Canadian equity, it's subject to tax. And to the contrary, with an exchangeable share structure, the Canadian shareholders remain in a CanCo, in a taxable Canadian corporation, Canadian entity, with exchangeable shares that essentially act as a proxy for the non-resident, the parent equity. So from a legal standpoint, they remain shareholders of a Canadian entity, but from an economic standpoint, they are essentially at the level of the foreign parent. We received a question from someone in the attendance as to why ULCs were more looked into by US purchaser when not only implementing exchangeable share structure, but really when acquiring Canadian targets. It's often that we see purchasers asking for pre-closing conversion or continuance into a ULC. And to address that question, really, it's a matter of US tax considerations. It's not really Canadian tax driven. And it's, I think, from past experience, really to either address US CFC and GILTI tax regimes that were enacted under Trump. So to ensure that the assets in Canada, the IP in Canada is not subject to the US GILTI tax. So that's one of the first reason. And the second one is that in certain, I don't want to say relatively limited circumstances, but in certain circumstances, that setup is used to essentially check the box from a US tax standpoint on the ULC, while having a disregarded LLC as its parent entity, direct parent entity. And it generally results in the Canada-US tax treaty not being available, but also result generally from a US tax standpoint again, in the ultimate parent, US parent, being considered for US taxes, US tax purposes, being considered to be the owner of the asset ultimately held from a legal standpoint by the ULC. And that can, again, be relevant for US tax purposes. So hoping that addresses that question. Again, I think the pros and cons of exchangeable share structures, the main pros is really that it allows for a tax deferred transfer for the Canadian vendors, while preserving essentially the business construct that all the vendors should participate into the foreign parent equity and not only in a Canadian intermediary entity. It also allows, and that's especially true with US purchasers and essentially US structures, it ensures that the Canadian vendor gets the same tax treatment as a US vendor, because quite often, a US vendor is able to get a tax-deferred transfer on the exchange of Canadian equity for US equity. So it ensures that essentially the whole vendor group, both US vendors, but also Canadian vendors, are entitled to a tax-deferred transfer. And the last point, and I think that's something I'll further discuss, is that structure can accommodate, if properly documented, reverse earnout and earnout mechanism. So the fact that an exchangeable share structure is either suggested by the vendors or by purchaser do not denature a business deal where a portion of the purchase price would be subject to any kind of contingency, whether it's structured as a reverse earnout or an earnout. And the cons, I think this is not new. It's really, those are the cons that always have been. So the first one is really to add a lot of complexity to a deal. It takes some time to prepare exchangeable shares documentation. So it's generally often costly, and not only costly to implement, but also costly to maintain, because that entails generally additional Canadian corporations for which customary both tax and accounting filings are required. The other thing is, and that's really fact specific, but some shareholders may push back against such types of structures, mainly because it's costly, delay generally closing, and those shareholders are really non-resident vendors that wouldn't be subject to Canadian taxes and can get a tax deferred transfer from their own foreign tax purposes, but also non-taxable Canadian entities that may not be particularly interested in putting into place a complex tax planning in contemplation of closing or contemplation of the transaction. What are the new things essentially that we have seen this year with respect to exchangeable shares transaction? The main one, I think, on my end, is really the fact that vendors, but also foreign purchasers, are pushing to layer on top of those structure contingent consideration items. So either by including earnout shares, either by including reverse earnout notes or amounts. So basically, the exchangeable shares, I think, are becoming more and more complex as a deal to document and to structure, because a lot of time we need as tax practitioners to take into account a business decision while make it work from a tax standpoint. Another thing we discuss a lot are a mechanism to address Part 6.1 tax. So exchangeable shares, they are taxable preferred shares. So generally, when dividends are paid on the exchangeable shares, assuming the dividends are in excess of the annual dividend allowance, those dividends are subject to Part 6.1 tax. So before, I think that was addressed by not or limiting circumstances pursuant to which dividends could be paid on the exchangeable shares. However, now I think that because of the economic context, I think a lot of vendors are looking to ensure that they would be entitled to any dividend paid, and not only in respect of ordinary course dividend paid by the ultimate parent, but really with respect to, for example, dividend recap transactions. So pursuant to which dividends would be paid by the ultimate entity and then reinjected in the foreign parent. And essentially, Canadian vendors now, because of the economic context in the US, are looking to ensure that if any such kind of transactions are implemented, they want to be able to share into those transactions. So to address that issue, honestly, there is a lot of ways to do it. Sometimes the funds are held in escrow. Sometimes dividends are not paid, neither paid nor declared, and then there's a catch-up provision after an exchange. And when representing something, I think is unfortunately often forgotten is when representing a purchaser, it's really important to help a non-resident purchaser with, the flow of fund management regarding distributions made on the exchangeable shares, essentially ensuring that any and all withholding taxes are paid appropriately, and also how to fund that dividend payment if there is not enough cash in the Canadian entity that issued the exchangeable shares. There are also a lot of foreign tax considerations discussions. It's not something we are, as Canadian advisors, generally the lead on, but I believe that in the US, there is more and more a certain uncertainty as to how to treat, from, again, a US tax standpoint, the exchangeable shares. Are they shares in a Canadian entity? So that's the legal reality. Or should we consider them as exchange, so as equity in the parent entity? And it's that consideration is extremely important because I think that the conservative position now in the US is to consider that the exchangeable shares are really direct equity in the foreign entity, such that any payment made on those shares to a non-resident of the country of residence of the paying entity would be subject to foreign withholding taxes. And for Canadian holders, that can be extremely detrimental because there is a certain level of uncertainty as to whether those foreign taxes would be subject to a foreign tax credit here in Canada. So again, those are discussions mainly driven by non-Canadian advisors. Other considerations. I think exchangeable share structure. There's always the possibility of providing for a sunset clause. So essentially, we keep the structure in place for a certain number of years. I think that more often than not, Canadian vendors push back quite strongly on that. And because of that, we see more and more US purchasers asking that the structure would be collapsed if Canadian tax laws are amended in a manner that allow a essentially tax deferred exchange between the exchangeable shares and the shares of the ultimate foreign parent entity. So essentially, they want to make sure that this structure, if not relevant anymore, not useful anymore, can be collapsed quite quickly because, again, of the costs of maintenance and of the structure. Another point, we see that, again, I don't think we see it more and more, but this represents a big part of our discussions when representing a purchaser, is how those rules, how that structure can impact a bump, if a bump is needed, for example, because the Canadian target has non-Canadian subsidiaries. So essentially here, I think it's something to keep in mind more than any kind of practice note. It's really if a bump is contemplated, again, similar to when a contingent consideration is layered into or on an exchangeable share structure, it creates a lot of complexity. And again, that adds to the already high complexity and of that type of structure. So I think unfortunately, there is no clear answer on that point. Some firms, they take the view that, the only thing that is relevant is the 10% threshold. And if we bust it, basically bump is not possible. Other firms, I think, take more not aggressive views, but some other firms are maybe try to address bump denial rules, even if the 10% threshold is exceeded. So again, on that point, it's much more something we're seeing more and more often because, again, of the economic context and the fact that for more mature targets, U.S. activities represent a lot of their revenues now, and so more often than not, a U.S. purchaser would rather have that revenues directly consolidated in their pre-existing U.S. structure. Two other things, and I'll go quicker on those two. Liquidity event, redemption / call. Essentially, sometimes we see purchasers trying to be able to redeem prior to a liquidity event to give them more wiggle room when negotiating the terms of that liquidity event. And I think it's something to be extremely mindful of when representing vendors. And the other thing is that now, when negotiating the essentially shareholders agreement, equities holder agreement in the foreign parent entity, so the agreement that would govern the exchangeable shares, we see terms that are more akin to terms we would see in an investment by a management member than by a third-party investor. And I think that it's something that should be addressed quite quickly, because if you are representing a vendor or are a vendor, I think that your investment in the US, the ultimate entity, is much more akin to an investment made by a third-party investor than by a member of management. I'll go very quickly on alternative structure because unfortunately there is not really any kind of alternative structure if you want to be able to do a cross-border acquisition while providing for a tax-deferred transfer by Canadian vendors. There are, that being said, alternative forms of cross-border acquisition structure, but I think that it's extremely important to keep in mind that to get tax-deferred transfer, barring very specific facts, more or less the only way to get there is to implement an exchangeable share structure. So I'll pass the mic to.
Thank you, Quentin. Yeah, so I'm going to talk about the impact of the change to the capital gains inclusion rate, which is, tax doesn't make the front page of the newspaper very often. Usually when it does, it's not a good thing. But this is an example of both of those. So I imagine most people here are well aware of this. On June 25th, the capital gains inclusion rate increased from 1/2 to 2/3, with maybe a little bit of an asterisk there that I'll talk about. When this was announced in the April budget, but in a somewhat unusual step, the government announced the change wouldn't be effective for a couple of months. There wasn't any grandfathering or valuation date concept, so they didn't say that anything you held before the date wouldn't be subject to the higher inclusion rate, or only the value accruing after the date would be subject to the higher inclusion rate. So it was very much an environment for go out there and do your tax planning. And it did lead to extensive planning, and many on this call probably were part of that, and made for quite a busy May and June. So we'll talk about the impact of that sort of in the M&A context, as well as at the same time the inclusion rate increase was announced, the government, is part of, I think, its messaging of this increase was only going to impact a very small, very wealthy group of taxpayers, announced several mitigation provisions or steps that were intended to offset some of the hit of this. I will walk through some of those again in the context of whether or not there's anything there that might be kind of game changing from an M&A perspective. Bit of a spoiler alert. I think the answer is no, but we'll talk about that. And then I will touch on briefly, I mentioned earlier, a bit of an asterisk, the fact that capital gains inclusion rate is still not, as of today, actually law. In an M&A context, one thing we're already seeing is a lot less flexibility with structuring. And so back in June, I think everyone ran to do their planning, and they effectively locked in a tax outcome by triggering gains or potentially triggering gains at a certain level or in a certain entity. So we now see buyers coming along and targets saying quite emphatically from the get-go, you have to buy this entity, or you need to buy these shares because I've already basically triggered tax in them, and if I sell anything else, it's going to be a huge problem. So as many of historically, there's often been a tension of asset sales, which tend to benefit buyers, versus share sales, which tend to benefit sellers. Asset sales, I found are very hard to kind of get anyone to agree to at this point, unless they're planning involved assets. But again, there's this messaging around, we don't have a whole lot of flexibility in terms of what we can sell you because of this planning we did. There's also going to be, for probably some period of time, extra due diligence, I think, as a result of the change in the inclusion rate. One, was the planning done correctly? As with all, even though we had a little bit of a window, if you go back, and I'm sure most of you weren't living this day to day like Quentin and I were, but the legislation didn't really come out for this stuff until kind of only a few weeks before the change was due to come into play. And so it really was a mad rush to kind of get this done. And, anytime anything is done as a mad rush, mistakes are made. And so I think, again, to the extent there's crystallization planning that will be inherited in a share sale, and again, I think we see these share sales as opposed to asset sales because of the planning, you'll have to look to make sure that everything was done correctly. Likewise, is there anything outstanding? A lot of the planning, was based on flexibility and the idea, well, I may or may not crystallize depending on what happens. And, one of the means of doing that was through the filing of tax elections, whether it would be an 85 election for corporations or a 97-2 election for partnerships. And so again, sometimes in the mad rush to get the initial deal documented, that stuff has been forgotten a little bit or isn't due yet or whatnot. So it'll be important to make sure that, is there anything that they would expect the buyer to do post closing, and what arrangements do you make around that to sort of make sure that everyone's expectations are met. Likewise, if people were triggering gains, a lot of these gains were based on partly because of the time pressures, internally generated fair market value determinations. So people would say, okay, well, I've decided I want to trigger a gain here to take advantage of the lower inclusion rate. I don't have a clear indicia of value, but I'm just going to say it was worth X. Well, if it turns out X was too high, that could result in an ongoing tax liability, or too low. So I think one of the things that, as part of due diligence that might have to be looked at is, if we're inheriting a company that has a tax liability, even if we've made provision for what that tax liability is in the purchase agreement, what's the risk that the taxing authorities will come along and challenge that? And you would normally expect to be able to address that in the standard tax indemnity provisions. But again, as part of the due diligence process, probably helpful to get a sense of, the likelihood of those issues being there. One issue that we're pointing out to people, because it may not be entirely anticipated, and it could be really relevant in some situations, is the impact of the inclusion rate change on reserves. And so reserves are sort of a tricky area of tax, but I'll try to kind of walk through it a little bit. So the idea is that for tax purposes, if you sell capital property, and the most common example of this would be shares of a company, real estate would be another one, but usually maybe it's shares. And an element of the purchase price is contingent. So the idea is, let's say, I'm going to buy your company and I'm going to pay you $10 million at closing. And then in 4 years, if everything's fine and there's no claims or anything else, I'll pay you an additional $2 million. So that $2 million of contingent consideration, the starting point for tax purposes is when you're reporting that disposition, you'd include that in your proceeds. So you'd say, well, I received $12 million. But the Tax Act allows you to take a reserve as long as certain conditions are met, so that you don't actually have to pay tax on the $2 million in the year that of the disposition occurred. And the way the mechanics of the act worked is, let's just say you took a reserve for the entire $2 million. Then the next year, so the taxation year following the year of disposition, that $2 million is recognized in that year, unless some of the consideration continues to be contingent, in which case you may be able to take another reserve to push it out. Now, the rules around each year, you have a minimum inclusion of reserves, and there's a cap on how much reserve you can claim. But this idea is that you can push the reserve out for several years. And this is creating a little bit of a problem in terms of the inclusion rate, because the way the tax works is when a reserve comes back into income, it comes back in as a deemed disposition of theoretical or hypothetical capital property on the first day of your taxation year. So let's assume you have a December 31 taxation year. If you sell something in 2024, and then you claim a reserve on it, you wouldn't include it in your income in 2024, but then on January 1st, 2025, you'd be deemed to have had a disposition of capital property for that year, unless you can take another reserve on it. So because of that deemed timing, reserves going forward, with the exception of this year potentially, which I'll get to in a second, are going to be taxed at the higher inclusion rate, even if the disposition occurred when there was the lower inclusion rate. So if you had a 2023 disposition when the inclusion rate was 50%, but you take in reserves and you don't bring that reserve into income until, say, 2026, when it comes in, you're going to pay it 2/3. Now, the one exception to that is in the current year. So given that June 25th, when the date changed, kind of was in the middle of everyone's year, people were reporting a tax return that includes that date within the period. And so if you had previously claimed reserves, if in your tax return for the year ending that includes June 25th, so again, let's just say you have a December 31, 2024 year end, if in that return You bring all of your reserves in, so you recognize them all, and you don't take any reserve going forward, you're deemed to have disposed of your capital property on January 1st, 2024, when the inclusion rate was 50%. But if you don't, if you take another reserve, you're going to lose access to that 50% inclusion rate. So effectively, people are going to be faced with a choice of either, for consideration that they could otherwise take a reserve on because it's not payable past 2024, whether they recognize it prematurely in order to pay at the lower inclusion rate or continue to get the deferral knowing they're going to pay at the higher inclusion rate. So that's a very live issue right now in the tax world. Okay, I mentioned the mitigation provisions that came along with the inclusion rate, and again, how these will impact the M&A world, or we expect they will impact the M&A world. The first is that, the inclusion rate itself is a little bit false in that every individual has an annual use it or lose it $250,000 exception to it. So this is basically for individuals for each year, the first $250,000 of capital gains that you realize are subject to a 50% inclusion rate, the old inclusion rate, as opposed to the 2/3, the new inclusion rate. This doesn't apply. This also applies to trusts and graduated rate estates. Most importantly, it does not apply to corporations. It's not prorated for 2024, so you can claim the full $250,000, even though the change only came in halfway through the year. But it's also not indexed, so it's not going to increase every year. And again, it's not cumulative. It's $250 a year, use it or lose it. It does create a significant tax cost to earning capital gains through corporations. And so for at least that first $250,000. So for instance, if we look at current BC rates, the effective tax rate on the first $250,000 of capital gains for individuals will be 26.5%, while for corporations it'll be 39.4%. So about a 12.5 point difference there. That's kind of unheard of in the tax world to have that big a gap. So again, in terms of structuring at an early stage, people are, considering whether or not to hold, they're considering the cost associated with holding investments through a corporation as opposed to individually. That limit as well, you may be aware of the $250,000. You might be aware of a stock option deduction whereby if you realize a stock option benefit, historically, you've been able to reduce that by 50% if certain conditions are met. That was changed at the same time as the capital gains inclusion rate. So the reduction was reduced to 1/3. This exemption also applies to that, but it has to be shared with capital gains. So between the employment deduction you might be entitled to and capital gains you might be realized, you get a total of $250. You can't double up on it. The next exception is an increase to the lifetime capital gains exemption. This would be lifetime capital gains exemption, as many of you know, is we usually see in the context of qualifying small business corporation shares. So private company shares of a Canadian controlled private company. So not relevant in the public company context, but can be very important in the private M&A context in that, again, in structuring, you'll often see vendors will say, we need to structure in a way to maximize our shareholders' access to the lifetime capital gains exemption. That issue, I think, it's been increased in importance due to the changes in June. Specifically, the capital gains inclusion or lifetime capital gains exemption limit was increased from $1,016,000, and that's a bit of a weird number because it's indexed for inflation, to $1.25 million, and it'll be indexed going forward. So, when you combine that increase to the lifetime capital gains exemption and the increase to the inclusion rate, the lifetime capital gains exemption has become considerably more valuable. So prior to the changes with the lower exemption and the lower inclusion rate, again, based on BC rates, a single exemption would save you about $270,000 in tax. With the higher inclusion rate and the higher exemption, that's increased to $440,000 in tax. And as many of you may know, there are sort of well-established tax plans that involve the multiplication of capital gains exemptions, often through the use of family trusts. So again, I think the importance of structuring private M&A to potentially allow people to claim their capital gains exemption is only increased in importance. No changes to the substantive requirements here. It's the same old test. It's just the threshold is increased. Moving on to a new program, and that's the Canadian Entrepreneur Incentive. So when this was first announced in the budget that included the capital gains inclusion increase, I think it was sort of dismissed by generally the tax community and beyond, because it seemed like they had a lot of conditions and requirements. And I think a lot of people said, no one's ever going to qualify for this. I think the federal government heard that. And by the time that the legislation came out for this in late summer, they had gotten rid of a lot of those requirements. So it's actually a fairly straightforward program now. And we anticipate that it actually could be a real, it could come into play, although the amounts ultimately, I think, are somewhat modest. But effectively, starting in 2025, that's actually a typo, apologize for that. It should be 2025. Individuals, but not trusts. So this is just something for individuals. Will have an annual cumulative allowance of $400,000 per year, capping out in 2029 at $2 million. So starting 2025, 400 grand cumulatively per year until you get to 2029. Now, again, this is another variant of what exactly is this? This is not an exemption, and it's not getting you back to the 50% inclusion rate. It's something in between, and that it basically, if you meet a qualifying transaction under this, the current inclusion rate is reduced by 50%. So then you'd be looking at capital gains with an inclusion rate of 1/3. So now we have, in certain circumstances, it's 50%. In certain circumstances, it's 33%. In certain circumstances, it's 66%. It's all very messy. And this would apply to a disposition of what's defined as qualifying Canadian entrepreneur incentive property. Well, what is that? It's very close to QSBC, the Qualified Small Business Corporation. Basically, you're looking at an active business. All or substantially all, so 90% of its assets are used primarily in an active business carried on in Canada. So this is a test that we're very familiar with in terms of QSBC. There are some modifications to it, though, and that's where this is not exactly QSBC. One is that the seller, the holder of the shares, must have held not less than 5% of the issued and outstanding shares for a 24-month period. So again, they want you to have a certain stake in the company before you can claim this. But 5% is generally, I think, viewed as a fairly low threshold. The seller must have been also actively engaged in a regular, continuous, and substantial basis in the activities of business for not less than 3 years. So they want, again, owner, manager, people qualifying for this as opposed to passive investors. And this concept of actively engaged in a business is taken from the tax on split income rules, which some of you might be familiar with. So there are a couple of additional sort of add-ons to QSBC, but we would anticipate, the last probably most significant add-on is it doesn't apply to an excluded business, which is, there's a list here that kind of summarizes them, mostly service-oriented businesses. So professional corps, consulting businesses, financial services, insurance, property, real estate, short-term lodging, cultural, entertainment, and recreational businesses. When it was originally announced, it was kind of like, there was a spin on this would be something for the tech community. And I don't think it's that limited, but again, I think it's sort of the idea of a non-service business. And so those are effectively the add-ons. And, just based on our client base, we anticipate that there are a number of people who, without having to do anything, will likely qualify for this going forward. That said, again, because of the lower, it's not a full exemption, it just lowers the inclusion rate. If you were to wait the full 5 years and get the full $2 million, and if it becomes law, you're looking at about, at current rates, about $350,000 in tax savings. So again, I don't necessarily see this as being something that would drive structuring, but would be something that probably, could make its way on when we're looking at our existing structure and determining what might be available there, is this there? The last mitigation step I'll talk about is employee ownership trust. This actually was announced in 2023, so it wasn't part of the inclusion rate change, but it was modified again, I think, because the initial reaction was it was too onerous. I still think it's this, my view of this is this program is likely going to have limited application, but it draws attention because effectively it allows for a maximum exemption of up to $10 million on a sale of qualifying property to an employee ownership trust. So, that's a big number when you kind of look at exemptions, a $10 million exemption. But as I say, it has quite detailed technical requirements and some punitive consequences for non-compliance. So I think that combination may make its use somewhat limited. In terms of the requirements, I'll just go through them briefly. This isn't an exhaustive list by all means, but these are some of the ones that jump out. The rules require that all employees of the business must be beneficiaries of the trust. So you can't pick and choose who's in this employee ownership trust. If you're an employee outside your probation period, you're in. Also, there has to be objective criteria determining how entitlements under the trust are determined. And those criteria have to be based exclusively on some combination of hours, remuneration, or term. So you can't have it be a discretionary trust where you say, this employee has just been such an excellent employee, they're entitled to more than this employee. It's got to be based on objective criteria. And there's strict anti-avoidance rules for any attempts to move around that. The trustees of the employee ownership trust must include employees, and it's limited to sale, again, of basically private company shares, of which in an active business, non-professional corporations, and the seller had to be actively engaged in the business. 75% of the employees must be resident in Canada. That's another requirement. And there are detailed restrictions for how the employee ownership trust is governed and how it makes decisions. If for some reason the conditions are not met after the sale is completed, the trust has to continue to be in place and meet the conditions. If it doesn't do so within the first 2 years of the sale, the exemption is lost. If it fails to do so after the first 2 years, then the employee ownership trust is deemed to have realized a capital gain equal to the amount that was claimed under the exemption. So really negative consequences if there's non-compliance. And so I think, again, that combination of complexity and severe sanctions, it remains to be seen how often it's going to be used. That said, you could see some fact patterns, and ones that have occurred to us might be closely held, profitable businesses with small employee groups, sort of a small group that you may be able to manage to meet these conditions. And we'll see. It certainly is, again, with the $10 million exemption number, it's an interesting concept. Finally, I'm just going to briefly, I have had people say to me, I've been reading in the paper or anecdotally, I've heard this isn't law yet. Is there any chance that, the capital gains inclusion rate is not going to happen? I think it's fair to say, and Quentin, let me know if you disagree, that that's highly unlikely. There's been no sort of suggestion by any of the other political parties that if in fact there is an election and there's a new government, that this won't become law. I imagine the logistical nightmares associated with it, would make it hard pressed for anyone to sort of backtrack on it. So I think certainly you should account that the increase in the inclusion rate is going to happen. It may be prudent to sort of not plan into some of the other stuff, though, in terms of the mitigation strategies, because perhaps those are more likely to fall away under a new government. Hard to say. But again, I don't know that necessarily any of those strategies are something that you would plan into. And with that, I will turn it back over to, oh, no, sorry. It's me on mandatory reporting. You get more of me. So mandatory reporting rules, just briefly, because we've talked about these for the past couple of years. So again, these were rules that were introduced and were in 2022 and became effective in 2023. They require certain transactions to be reported to the Canada Revenue Agency. And there's two categories. One is reportable transactions, which meet certain statutory conditions. So there's certain tests that are laid out. And And then there's a second category of notifiable transactions, which are transactions that are substantially similar to transactions designated by the minister. And we've got a link in the slide that has an up-to-date list of transactions designated by the minister. Again, these rules provide that if you don't report either a reportable transaction or a notifiable transaction, there are adverse consequences, including significant financial penalties and an extension of reassessment periods. So they're definitely in play. We're now seeing, many of you will have seen in M&A documents, representation and warranties as to the non-application of these rules, as well as covenants detailing how the parties will deal with the rules if one of them thinks they may apply. There seems to be a lot of uncertainty still out there about, compliance on these things. We hear anecdotally, that some firms are taking a view of report everything. Other firms are relying more on the statutory safe harbors. I was last week at the annual tax conference, the Canadian Tax Foundation's annual tax conference, and they had a panel on this. And there was a crowd of about, I'd say, 500 people. And they did polls that people would answer in real time that would say, okay, this is the fact pattern. Is this a reportable transaction? And almost to each one, it split 60-40 or so, sometimes 50-50. So that's deeply troubling that, a year in, even within the tax community, a lot of disagreement and a lot of uncertainty about exactly where these rules are. So just again, a reminder, they're out there, they're active, and be thinking about them. Now I'll turn it over to Quentin.
Thank you, Mike. We thought it would be a good idea to revisit a couple of incentive plans and how those plans factor into M&A. And I think that the main consideration is really whether or not a unit or an interest in an incentive plan can be rolled into the acquiring company or any kind of other resulting entity in the course of that transaction. There are many reasons for that. So, for example, the purchaser wants to continue to incentivize management without having to incur that additional cost on closing with respect to the liquidity event and potential payout under the incentives. Prior to the presentation, I received a question on how to address essentially the tax considerations of the various incentive plans with participants, because more often than not, tax advisors, whether lawyers or accountants, we generally advised against having a full-blown technical discussion with participants as to what will be the tax result provided for under the plan. And I think that on that, my advice is really you need to avoid providing certainty. As an employer, you can't provide a result. You can only put into place to the best of your ability a plan that would or should result in something, but you can never, or you should never give any kind of firm statement as to what would be the tax considerations with respect to the regime. And I think that a natural out is that there is a lot of things that an employer can do while putting into place an incentive, like any kind of incentive plan. But the employer is never able to control what the employer will do in the future or what will be the circumstances of the employee on the settlement of the units or the plan. So I think all that to say, you can advise, you can inform, but you should never conclude vis-a-vis your participants. So I think I'll delve right into the subject. So for stock options, I think pretty much everyone is aware of that. It's possible to roll over options of a particular corporation into options of another particular corporations. There are a couple of criteria to respect, but this is possible. Likewise, if the options are not rolled over, the stock option deduction is generally available on exercise and or cash out, assuming everything was done correctly and that the plan provide for the right ingredients for the employee to get the deduction. And lastly, and that's something new, it's really important to assess now whether a portion of the options that are settled and or exercised, whether or not those options are non-qualified securities. And it's new because that concept exists only since 2000 the middle of 2021. Before then, it was impossible for an issuer to grant stock options that were non-qualified securities. And I think that here the gist of it is really in the context of a transaction where the issuer could have issued non-qualified securities, so a non-CCPC that has more than 500 million of gross revenues on a consolidated basis. It's particularly important to determine whether or not such options are outstanding and how to treat them in the course of the transaction. RSU, so restricted stock units, performance share units. So those are the 3 years plans. Unfortunately, those can be converted or rolled. So really here, plans of more often than not, and honestly, I think I never seen a plan that wasn't providing for that, but the plans provide for an acceleration on a change of control transaction. And one thing to keep in mind, however, is that if the board or the compensation committee wants to extend that settlement period, that 3-year period, due to a potential transaction, a blackout period, or whatever, it's extremely important to advise them against that, barring except very specific facts, because in that case, the payment would really be made outside of that 3 years period, and the employee and the employer would run the risk that such units be considered to be salary deferral arrangements for purposes of the act instead of, plain vanilla RSUs and PSUs. Small comment, and it's a comment I'm making also for DSUs, so deferred share units. If the corporation is required to settle the units in treasury shares, so RSUs, PSUs, and DSUs can be considered to be valid agreement to issue shares, such that Section 7 of the Tax Act would govern those units instead of the salary deferral arrangement rules. Quickly on the DSUs, same comment, again, same general comment. Those units are generally accelerated, with the caveat that acceleration can't be provided for in the plan of the DSUs, because DSUs, it's kind of a recipe contemplated by Reg 6801D of the income tax regulations, and those rules, that recipe requires that settlement can only occur on death, termination or retirement. So possible to sell them. There are a couple of rulings where the CRA clearly accepted a settlement in the course of a change of control transaction. However, the important part is that this cannot be pre-established. It has to be negotiated with the participant at the time of the liquidity event. And lastly, that's something we see slightly more often now, and I think it's because of the changes to the stock option regime that happened in 2021 and the non-qualified securities. We call them TSUs, so treasury stock units, and essentially those are RSUs or PSUs that you settle in treasury shares, such that the whole plan is governed by Section 7. So the advantages are you can defer more than 3 years. You can grant units with an in-the-money value. But from that result the fact that the stock option deduction would likely not be available to the participant, barring the application of the CCPC stock option deduction that is generally not applicable here, because those types of plans are not put into place by CCPCs that can, provide for a much better result by issuing penny stock option under, plain vanilla stock option plan. I think on that point, and we're short on time, I think on due diligence issues, I'll go in, I'll discuss only the meat. It's again, relating to M&A, I think we're all relatively familiar with the tax due deal process. What can we do? What we need to look for? Something that we're seeing both Mike and I, and it shows that it's something that is very trendy with purchasers right now, is the very detailed diligence of U.S. sales and local tax exposure of potential Canadian targets. And that very detailed due diligence process often result in U.S. purchasers asking for a very fulsome and detailed tax escrow arrangement that essentially provide for the withholding the escrow, so withholding of a portion of the purchase price, and then the filing of voluntary disclosures in the U.S. with respect to U.S. sales and local taxes matters, to ensure that U.S. purchaser does not have to deal with those issues going forward. So basically, the gist of that process is really when negotiating the agreement, we agree on in which states voluntary disclosures would be filed, how the funds in escrow would be used. So are they used to only pay potential tax liabilities, so tax interest and penalties, or can they also be used to fund essentially the compliance expenses relating to the voluntary disclosures? And on that last point, I think everything is pretty much negotiable. There is no clear practice. That being said, I think that when we are advising vendors, it's important to cap any kind of portion of the escrow that could be used to finance advisory fees, just because we want to keep those fees under control, especially since the client here will not be the vendors, but really the purchaser. And when we're representing a purchaser, I think to the contrary, as a purchaser, those voluntary disclosures are really in respect of a pre-closing tax risk. So there are good arguments to make that any compliance expenses relating thereto should not be borne by purchaser. And I think that a middle of the road approach is really to for the vendors to say, okay, but I will choose my own advisors and I will deal with them separately, and you'll have review rights, but I will be the client, me vendor, you will not, you purchaser. Another example, it's with respect to this is less common, but sometimes we see purchasers wanting to keep a certain amount in escrow in respect of the filing of amended tax returns. So for example, to claim not new loss, but losses that should have been claimed, claim tax credits that weren't or should have been claimed. And often we see purchasers wanting to have vendors put a certain amount of money in escrow to make sure that any kind of fees or taxes, interest, penalties, any kind of liabilities that would result from the filing of such amended tax returns would be borne by the vendors. I noticed we received a couple of questions, so I don't know, Mike, do you want to finish the presentation? We have 2 slides, everyone, so maybe you can finish the slides and then we'll address a couple of the questions we received.
Yeah, that'd be great. It'll be quick.
Okay.
I think on the GAR, again, general anti-avoidance rule, most of you probably have heard about it. Just wanted to make everyone aware that as of January 1st of this year, we have a new GAR. It's been amended and revised. There's a new test within it, significantly lacking in economic substance or SLES. So just in case lawyers love their jargon, so if you start hearing that, that's what we're talking about. There's also a penalty associated with GAR for the first time equal to 25% of the tax benefit, unless the transaction is voluntarily reported. Lot of debate in the tax community about how much the GAR has actually changed and the implications. In terms of impact on M&A, my view is within a deal, there should be, between the parties, there should be very little impact. And I just actually gave a presentation at the same tax conference I I mentioned earlier on exactly that. So if you've got a spare hour, I'd be happy to tell you why I think it shouldn't have any impact on M&A, or I can send you a copy of my paper. But what I do think it may have some implications is on structuring and some of the plumbing around deals, because to the extent that people are doing acquisition structuring involving, interest expense and financing or debt capitalization or really any of those elements, to the extent in the past they've relied on plans that were perhaps vetted for GAR, there's going to have to be a revetting. So I think people may be a little bit more cautious, a little bit more deliberate, and it might take a little bit longer for them to kind of lock in sophisticated tax planning, because at least in some people's view, we're starting, relatively new with the GAR. And so we've got to revisit all that. So that's where you may see some of this, is people just being a little slow in terms of what exactly they're going to want to do big picture. But again, I don't think it should have much impact on the day-to-day sort of M&A activity. And Quentin, I'll turn it over to you to finish up with Quebec.
Thank you. So Quebec specific matters. I think the gist of it is pretty much everything that was announced in 2024 by the federal government will be harmonized in Quebec legislation at the same coming into effect at the same dates as the corresponding federal measures. That said, the following two measures were not retained by Quebec: so the clean electricity investment tax credit and the mineral exploration tax credit. Another item that remains unchanged is the fact that in Quebec, the stock option deduction historically hasn't been of 50%, but when you have really of 25%. So this remains unchanged essentially because the rate is lower than the revised federal one. So the federal one was reduced to a third. So Quebec essentially didn't want to harmonize it up and kept it at 25%. And lastly, and this is more of a housekeeping item, the withholding for taxable Quebec properties, the withholding tax rate for Quebec tax purposes will be increased to take into account the increase in the capital gains inclusion rate. So I think on that particular point, extremely important to remain mindful of that, because I think that on TCP withholding, I don't think the Quebec withholding is forgotten, but sometimes we see that it's a bit of an afterthought or something that was raised maybe late in the game. So again, the rate is changing. I think it's a good opportunity to keep that in mind if you are involved in the disposition of TCP.
Yeah, it's great. And as you mentioned, when we do have a few questions here, I'll just go through them quickly here because there's some good ones. So to me, I guess when I was talking about reserves, so reserve taken into income in future years from the disposition of QSBC shares in 2024 would not be eligible under the incentive program? That's a very good question. And I think it's unclear. So again, the idea, I think maybe what the person asking the question was thinking is, I sort of said, listen, you might want to recognize your reserves early in order to get access to that 50% inclusion rate. But again, individuals have that annual $250,000 limit. So it may be the case that if you had, your reserves coming in were below that limit and you had individuals or trusts taking the reserve, because again, the reserves that the entrepreneurial incentive doesn't apply to corporations, you might be able to claim it, but I think it's unclear because even like historically, that became an issue with capital gains exemptions where people say, well, when I bring my money back in as a reserve, can I claim the capital gains exemption? And the answer is yes, but it relies on an administrative position of the CRA. I don't think the Act is crystal clear on that. And to my knowledge, at least, the CRA hasn't confirmed that. So I think that's a little bit of TBD, but it's a very good question. And I hopefully will have clarity on that not long into 2025, at least, before people have to decide, whether or not they're going to accelerate their reserves. So I think, Quentin, there's a question on the call codes there, if you wanted to take that one.
Of course, of course. So the question is, what is the purpose of the call co between target and acquisition co? So we're back to the exchangeable shares structure. So essentially, we are deferring exchangeable shares. It's a deferral play. So in order to be a deferral play, we need to ensure that on the disposition of the exchangeable shares, that disposition will be structured as a, disposition instead of a redemption. So Callco is essentially formed as a sole purpose entity, with the purpose being that instead of allowing a redemption at the level, a redemption of the shares essentially between buyer co and the holder, any kind of retraction, so at the request of the holder, or redemption at the request of the corporation, is overridden by a right of Callco to, instead of instead of having the redemption occurring, the retraction occurring, Callco is granted a right to acquire such shares. So essentially, it ensures that in no circumstances the exchangeable shares would be redeemed, because otherwise the result is a detrimental result, in a sense that the vendor would get a deferral, but would lose in turn on the tax rate, because the redemption would be taxed likely at a higher rate.
Thanks, Quentin. I think we have maybe time for one last question, and that is, this is a classic one. I understand the 2024 tax software is using a 50% inclusion rate until the new inclusion rate becomes law. How is that going to work? Yeah. So again, the background here, good question, is people have found, and maybe some in the audience have, that if you actually, as you might know, any software where you can, complete your tax return and have it automatically filed has to be blessed by the Canada Revenue Agency. And the Canada Revenue Agency's policy is they cannot bless draft changes to the Tax Act. It actually has to be law. So current tax software, when you report your capital gains, it forces you to recognize it at the 50% inclusion rate, even if your capital gain was after June 24th, which is just head shaking. And so a lot of questions about what to do on that. The CRA 2 weeks ago came out and said, as with all draft legislation, we're administering the act as though it's law. We think, and I believe they anticipated that they would have updated software by the end of January of next year. And they indicated very vaguely that there would be interest and penalty relief applied, basically for people who had to file tax returns before, I think it was March, the middle of March, the beginning of March. Again, I think the idea behind that, although it's not crystal clear, is if you have to file a return using the old software, so you report a 50% inclusion rate, as long as you amend that return once the new software is available to increase your gain, they're not going to charge you interest and penalties for that. But that's not absolutely clear. They also said they were going to release more information in the coming weeks on this. So the short of it is they're aware of it. There's been a little bit of information on how it'll work, but it's far from certain, which is often a good description of tax. So I think that's it for today. Thank you, everyone, for joining us. If you do have any questions afterwards, feel free to reach out to Quentin or I directly. Our contact information should be in the materials. And have a great rest of your day.